The Kansas City Approach to Modern Money Theory by L. Randall Wray. Section 6. Financial Instability. Hyman Minsky is the most important contributor to developing our understanding of the inherent tendency of modern capitalism to evolve toward financial fragility over the course of the cycle. His financial instability hypothesis was developed between the late 1950s through the mid-1970s, with a full exposition in his book, John Maynard Keynes, 1975. He claimed to extend Keynes's investment theory of the cycle by adding the financial theory of investment. Minsky's understanding of banking and finance integrated the banker as the FOR of capitalism view of his dissertation advisor, Schumpeter, with the broad approach to money and banking by Gurley and Shaw, who recognized the importance of what we called non-bank banks, until Paul McCulley renamed them shadow banks. Minsky also had a good understanding of Ritter's integration of cash flows and balance sheets to produce a flow of funds matrix. He argued that every economic entity can be analyzed as a bank that issues liabilities to take positions in assets. He further argued that anyone can issue money, a liability denominated in the money of account. The problem is to get it accepted. And as discussed above, he not only kept up with the financial innovations, but recognized how they had stretched liquidity and increased the potential for fragility. In all these respects, he pushed the generalization of money in banking to the limits. Footnote 31. Minsky wanted to explain the endogenous processes that produce financial crises, rather than focusing on irrationality or what he characterized as idiosyncratic causes, such as fraud. Ironically, he had used the name of fraudster Charles Ponzi in his classification of financial profiles, something he later admitted to regret. This is not because he doubted that fraud is important, but because he wanted to explain why things go wrong even without speculative bubbles, the focus of Charles Kindleberger, or fraud. When I analyzed the saving and loan S&L crisis of the 1980s, I included multiple causes, not only Volcker's monetarist experiment and Minsky's financial instability hypothesis, but also fraud. It was my study of the saving and loan crisis that introduced me to Bill Black's work. When Bill first came to UMKC, he warned that by ignoring the role of fraud in the mid-2000s, we would be missing the most important factor contributing to the upcoming crisis. I became convinced that he was right, and we co-authored several pieces on the role of fraud. See, for example, Black and Wray, 2010. See also Wray, 2020, Part A, for a discussion of fraud as a business model. End footnote. Minsky recognized the importance of New Deal and early post-war reforms that had produced an unprecedented period of prosperity and financial tranquility, but he began to warn even in the 1950s that this would change behavior. He argued that while institutions can constrain instability, inherent market processes would reduce their efficacy. Unlike most analyses of economic cycles, Minsky's view was that the invisible hand of the market was destabilizing, while the visible hand of institutions, including prominently the visible hand of government, could produce a semblance of stability. But stability is destabilizing. When he moved to the Levy Institute in 1990, his focus turned to analysis of the long-term transformation of the financial system over the past century, identifying several stages of capitalism, each associated with a particular type of financial system. Minsky had always joked that there are 57 varieties of capitalism, a reference to the Heinz Pickles slogan. But this work focused on the rise of money manager capitalism after 1980. In his view, this was a stage that was similar to the era of finance capitalism that crashed into the Great Depression. He worried this might happen again, from the title to his 1982 book. At the Levy Institute, he created the long-running annual Hyman P. Minsky Conference on the State of the U.S. and World Economies, held each April to formulate proposals to reconstitute the financial system. In his view, the key to reforming capitalism is to reform finance, because he viewed capitalism as a financial system, and as the financial system evolved, the form of capitalism did also. Footnote 32. See Timwan and Wray, 2014. End footnote. Minsky had long argued that both the big government and the big bank should play a stabilizing role in the economy. The first refers to fiscal policy, and the second to central bank policy. Minsky argued that the growth of the federal government from approximately 3% of the economy before the Great Depression to above 20% after World War II gave it the weight in the economy to offset fluctuations of private spending. Like Keynes, he viewed private investment as the main source of fluctuation. With the government's budget balance moving countercyclically, it could potentially attenuate capitalism's natural propensity to boom and bust. He identified three effects of countercyclical budgets: the income effect, the cash flow effect, and the portfolio effect. Minsky, 1986. The first is the usual Keynesian multiplier notion, except that Minsky emphasized the automatic movements of transfer spending as well as government spending on interest. The second derives from the Kalecki profit equation, which Minsky added to his approach after his 1975 book. Growth of a government budget deficit in recession can offset the impact on profits of falling investment. Footnote 33. In the simplified classical assumptions, Kalecki equation, aggregate profits are identically equal to the government's deficit plus investment plus the current account surplus. End footnote. This would help to maintain profit flows so that firms could service their debt, helping to prevent a Fisher-type debt deflation where firms must sell assets to make payments on debt, pushing asset prices down. Finally, government deficits put safe government bonds into portfolios precisely when firms crave them and help to fuel the recovery, as they can be used for collateral when borrowing begins again. Minsky had argued that one of the legacies of World War II's huge budget deficits was the large amount of government debt in private portfolios. This helped to maintain robust balance sheets, filled with safe assets, over the post-war boom as private firms and households began to borrow. The most important role of the big bank, central bank, is to act as lender of last resort in a financial crisis. This puts a floor to asset prices, again, helping to prevent another Fisher debt deflation. This was the monetary policy counterpart to financial policy's role in setting a floor to aggregate demand. But because Minsky was also worried about the tendency toward runaway euphoria, he wanted fiscal policy to help enforce a ceiling on aggregate demand, and monetary policy to likewise put a ceiling on asset prices. Hence, the budget should move toward surplus in a robust expansion. The counterpart to lender of last resort policy was banking supervision and regulation by the central bank, and, in the case of the United States, by the Treasury through the Office of the Comptroller of the Currency and the Federal Deposit Insurance Corporation, which share responsibilities with the Fed. Unlike mainstream economists, Minsky did not believe the central bank can control the money supply through control over bank reserves. Instead, he wanted to influence bank lending, mostly by supervising the quality of assets banks purchased. Minsky argued against the two main policy proposals of monetarists like Milton Friedman and Alan Meltzer: money supply growth rate rules and use of open market operations to supply reserves. The first would be ineffective. As early as 1957, Minsky argued that banks could economize on reserves by innovating, so that even with control over the quantity of reserves, the central bank could not control the growth of money. The second would diminish the central bank's ability to influence the quality of assets banks held, and thus the types of lending they financed. Minsky wanted to force banks to the discount window for reserves. He argued that the Fed, like any other bank, would then get a chance to look at the books of the borrower, in this case a bank that needed reserves. The Fed could demand changes to bank behavior to reduce risky lending or lending to activities that it did not want to encourage. This would help advance the Fed's role in supervising and regulating. Unfortunately, Minsky ultimately lost both of these debates, as the Fed increasingly turned to open market operations in the 1960s, over the following decades increasingly using the discount window largely for emergency lending to troubled banks. And Volcker's Fed explicitly adopted money growth rate rules in 1979. Each of these in their own way helped to bring on the transformation from a relatively robust financial system at the beginning of the 1960s to what Minsky termed money manager capitalism by the 1980s. Minsky's framework had always been part of the Kansas City levy approach to MMT. When I first arrived at the University of Denver in 1987, I began to teach a course on Minsky using his 1986 book. That continued at UMKC and now at Bard and Levy. Minsky's views of banking and financial markets, his views of the nature of money and the role of the government in the monetary system, his recognition that the market is naturally unstable, and his policy reforms have always been part of our approach to understanding how money works and how policy can be used to reform the system.